All right, it's 12:01. Let's get started. Thank you for joining us, everybody, on today's quarterly economic market outlook call. My name is Sean Patton. I'm the champion partner here at CNC Financial Group. Just a few household items before we get started. If you are a current client on today's call, thank you for allowing us to be your trusted tax and financial advisors. Our team is always available to answer your phone calls and emails, so please don't hesitate to contact us with any questions or concerns about your accounts, even if that's between your regularly scheduled meetings. If you're new, welcome. We would love to get to know you. We offer a complimentary discovery meeting to show how we can create a customized plan to assist you on your path to success. Give us a call, email us, or send us a message through our website at www.cnccpa.com. We differentiate ourselves from traditional wealth advisors by focusing on tax efficiency as a part of your overall strategy. Whether that's in the accumulation phase or the distribution phase of life, that additional value is created through a cohesive relationship between our CPAs and in-house financial advisors. That process begins with a holistic approach as we review your personal financial planning needs that are unique to you and your family. The more we understand about your vision and goals, the better we can help prioritize and meet and realize meaningful progress. As a reminder, during today's call, please use the Q&A button to submit any questions that you have. These calls are for you, and if you want to get the most out of it, please ask the questions that you have, and we'll field those after the call. This recording is also posted to our YouTube account, so let a friend, family, or colleague know if they missed today's call. It's archived for them there. All right, it's my pleasure to introduce you to our guest speaker today. Mark Eibel is back with us. He's the Director and Chief Investment Strategist for Russell Investments. He's been with Russell for 38 years and is a regular on CNBC and Bloomberg TV discussing economic trends and opportunities. Our firm works with Russell Investments out of Seattle to provide our clients with tax-efficient investment portfolios. They've been kind enough to offer our tax and financial services clients this regularly quarterly economic update. So let's get started. Mark, thanks for joining us again after a brief hiatus last quarter. We're excited to hear your thoughts on the fourth quarter of 2025, as well as economic market outlook moving into the future. So I'm going to turn it over to you.
All right, the band is back together. So sorry for missing last quarter. You were in great hands with Ryan. So I'm going to do what I normally do, hit on a subset of slides that cover kind of where we've been and where we're going. The where we've been part is fun because last year was amazing. So we'll kind of start with that. For those of you that have their bingo card out for me, I'm going to hit on the same three things that I normally do. Have a plan, manage your taxes, and stay in the game. And the look back, man, I don't know if I've ever had a year where stay in the game stayed more appropriate. So let's get right into it. Let's go to the first slide there. We have 100 years of data. So the data series that many of us use in the United States starts at 1926. So it's kind of fun. We've used this one before in different forms. This is just U.S. equity, kind of U.S. equity stocks. We've used it with asset allocation and stuff before, but it's kind of fun to be able to say 100 years. And I mean, just look at that. I mean, just the picture tells the whole story, right? So if you add them all up, we've done it for you. 74 of them are to the right or the positive side of zero. So we'll call that 3/4 of the time. Orange is last year, 2025, a great year, and yet the U.S. wasn't even close to being the best market last year. Emerging markets are up over 35% in U.S. dollars. International value stocks, which is a lot of really cheap financial companies and banks, they were up over 40%. U.S. was phenomenal, but everybody won last year. Infrastructure and in that space did well with the AI spend. We'll talk a little bit about that. Bonds made you 6-7%. You're just clipping coupon and interest rates drifted down. So you got a little bit of a price kicker. I mean, all you had to do was be in the game. So did a lot of calls at this time last year, obviously coming right off of the of the election. And as I've always said, half the time you win, half the time you lose. Usually when you win, you're kind of happy. Usually when you lose, you're kind of sad. I think in this particular election, I think if you were happy, you were really happy, and if you were sad, you were really sad. And that shows up in the consumer sentiment numbers, which are still negative despite how much money people have made. Usually they travel together. I think it's the politics coming through. A lot of people who said, I'm out, I'm just going to take my chips and go home, so to speak. And I always kind of frown on that because you're going to have to figure out when to get back in. And again, markets in the meantime, whether your side wins or loses over 100 years, goes up 3/4 of the time. So in last year, that was a painful decision. So stay in the game certainly played out for last year. A couple other observations about this slide. Number one, look how many of the 20% and higher. I mean, that is a lot of periods. I mean, so it isn't just that, we all kind of expect, and we'll talk about it a little bit later, markets give me 5 to 8% a year. Well, actually, you've gotten double digits annualized over the last 100 years. You can see in the box there to the left. And in some of these periods, quite a lot of them, I mean, you really did well. On the other side of the chart, there just aren't that many observations, particularly when you get to 20% or down markets, and three of them are in the 30s, which, yeah, wasn't a great time period for financial markets with the Great Depression, right? So, I mean, you got 31, 30, 31, 37, and even 41 clustered there. You go since 1941, you go 75 years. I mean, that is just not that many observations. So, I mean, this is just, it's a proof statement of the economic engine and wealth creator that the U.S. economy and market has been for the last 100 years. So it's fun to put up 100. The ultimate stay in the game chart. Most of us don't have a time horizon of 100 years, but as I can tell you from taking my father recently at 92 years old to his annual wellness appointment, which is kind of interesting, and we have some laughs along the way, including with the doctor. You are probably going to live longer than you think you're going to. So I do think the staying in the game is appropriate, even if your time horizon might not quite be 100 years. So my youngest daughter and her husband are expecting their child will have a 100-year time horizon, I believe. So anyways, let's move on. But I love this slide. It's one of my favorite ones to do. So let's continue with the U.S. equity theme. We've talked a lot about the Mag 7. This is just kind of the top 10 stocks in the U.S., and a lot of them are those Mag 7 names. Dominant return drivers, particularly in recent years, and we just put 2023 and 2024 on here on how much of your return you were getting just from these names, right? And again, to kind of shape it and put it into perspective. So the U.S. is about 2/3 of the world's market. We've talked about that in previous calls, which is why we have about 2/3 of our money in the U.S., and we still do. Talk a little bit more about that in a second. But so 2/3 of it's in the U.S., and about a third of that or more is in 7 names. I mean, it's as if the entire world's like retirement plans are reliant on 7 names, largely technology related, all in one country. So while your 60/40 for the last 10 years has done just fine, uh, it's an interesting way to get it, right? You didn't really make much on the 40 being your fixed income portion. And I'm not saying you have to be 60/40, but that's where a lot of the money kind of plus or minus ends up. Um, you made most of it in one country and you made most of it in a handful of names. Well, 2025 was a little different, and I'll take 2025 all day long. Was really kind of the Mag 2. NVIDIA and Google/Alphabet were the two outperformers there versus kind of the broader market that are in that group of 7 names. Smaller companies did well. Everybody did well. Again, as I said, non-US did even better. Emerging markets did better. Your bonds, did their job, as I mentioned. It's a better way for me personally, or I mean, I would much rather have a diversified way of getting my 60/40 rather than just the reliance on a handful of names. I mean, they're in the country that I live in and that I love. I mean, I love that, but I don't care if they were all US companies or all somebody else's a different country's companies. It's not as healthy of a way in order to get your return. So I'll take 2025 all day long, but we just wanted to put this in here because so much of the conversation has been on this handful of names. There was a transition that happened last year. Let's talk a little bit more about the US versus non-US kind of story. I get asked all the time, markets are at an all-time high, at least here in the US. Why do I want to invest in a market that's at an all-time high? Well, if you reflect back on the first chart, if 74% of the time the market goes up, you spend a lot of your life, quite frankly, at or near all-time highs, right? Just by how the math is. So if you're going to get out when markets move up, you're going to be out a lot, right? Now, we also realize implied in that statement means, well, that means you would buy if the market went down, which is really hard to do, by the way. I know buy low, sell high is economics 101, but it's actually really hard to do in real life. Uh, if you automatically rebalance, that's probably the easiest way to do it. You just automatically are trimming things that win and buying things that are cheaper. But what we're talking about here is all in or all out kind of mindset, right? It's really hard when markets are going down dramatically. Think COVID, think global financial crisis. Think about, tech crash in 2000, those type of events. Man, jumping in at the bottom of those, yeah, you're getting a deal, but it's hard to do. So you kind of get into this behavioral trap of, well, you don't want to invest when markets are up and you don't want to invest when they're down. Well, that means you're going to be out of the game like your whole life, right? So to answer the question about the US market, we look at a couple things on this one. The bottom half is a typical valuation. Just are you expensive or are you cheap? PE ratios, price over earnings is a common measure. What am I paying? What earnings am I getting? The E, and what am I paying for that, right? And usually when we get into these ranges that we're in, we're above 20 on a PE in the US. Usually that doesn't bode so well moving forward. That's usually a sign that we're getting frothy. Now, if you strip out those 7 names in the US, the Mag 7, the other 493 are not trading as high as that. So the broad market's not that expensive, but the US is certainly a more overvalued market than the rest of the world. So a couple comments on that. Number one, valuation. I have learned in my 40 years, valuation is not a good timing tool. Meaning markets can keep going up a lot longer than you think unless something happens in order to change that. And when I take that mindset and I look at the top half part, I mean, profit margins. So the bottom half is the US is in orange, the rest of the world's in blue. The US is more expensive than the rest of the world. Okay. Top half is, well, what about when I look at profit margins, which is basically the health of companies? Man, look at that orange line for the US. I mean, we are, as we showed in the first chart, I mean, we are a developed, mature economy, and our companies, AI is certainly part of it, are being run very efficiently. So if you keep banging out these kind of profit margins, yeah, I think US stocks can go higher. And when I look at the drivers this year in the US, I mean, I don't know what can derail it. Quite frankly, we get 2 news items a day ever since the election that could derail this market, and nothing has really done it, right? So I don't know what can derail it, though I know there's something out there that will. But when I look at what could keep it going up, I think it's largely the same drivers as last year. Number one, the spend on artificial intelligence is not going away. And we can all wonder, how do these companies make back billions and billions of dollars? Take yourself back to 2000, though, when the internet, or prior to that, I don't think any of us, if you had asked us then how much of our life was influenced in ways we never imagined here 25 years later, I would say those companies got their money back, right? And we all benefited, and so did companies running their businesses. So I don't think we have any idea how the whole AI spend is going to work its way into the economy. But that's what we do, right? We innovate. So I mean, the AI spend is going to continue this year. That's an add to economic growth. The consumer, particularly the wealthier consumer, is showing signs of dipping into their savings and accumulated wealth to fund their spending, but they're still spending. And as long as that group is spending, that keeps us out of recession as well, right? Number three, it all kind of works its way into what you see on this top part of this chart. Earnings are good. We should be 10% earnings growth year over year. We are in earnings season right now, and earnings have been good. And then there's central bank policy. Federal Reserve is either going to keep interest rates where they're at, or maybe cut them maybe in the second half of the year. But the trend is either stay where you're at or lower interest rates, which again tend to be positive for markets. So when I look at those 4 drivers, I think they're all in place for this year. So I could see the US going up. Now, does the hurdle get higher the more expensive your market gets? Sure. That's why I love having a third of my money outside the US, because I think this could be another year in which the rest of the world outperforms. Not because we drop off dramatically, but the rest of the world is cheaper. The rest of the world continues to pay a nice dividend that people seek. And when technology slides at all, the rest of the world wins. And I get a currency hedge. And I want to talk about currency for just a second. Currency, the dollar weakened. You hear about it in the news all the time. And in your mind, you probably think, man, that's always got to be bad, right? Not necessarily. There are aspects that a weaker dollar is better for. If you're an exporter, you like it because people will buy more of your things if it's cheaper. Well, as far as returns go, the dollar's been strong for almost 20 years, right? And there's a lot of good things that come from that. It means money's coming into our country. We are reserve currency status, safe haven, all of that. Well, over the last year, some of that has moved out for a variety of reasons that get talked about all day long. One of it could be people are just going, I've made a lot of money there. The rest of the world is cheaper. They've cleaned up their act. They don't have to do as well. And some money's moving outside the US. Some of it's moving out because, again, people have very strong political views. And so they're moving money out of the dollar. And that's one of the reasons we'll talk about gold in just a minute on why gold has had such a big run. There's a number of reasons, but if for no other reason, currencies are like any other security. Buy them low and sell them when they're higher. And it's been high for like going up for 20 years. So there are managers that trade currencies just like anything else. So currency last year for all of these drivers weakened. And as I've explained in previous calls, if you make money outside the US, you translate it back into your home currency, right? We like to spend it in dollars. Well, if the dollar's cheaper, I get more of it. Just like I get more gas if it drops for the same amount of price. I get more bananas at the store if the price drops for the same price. I get more return in the currency translation. It's a tailwind. I've had an 18 to 20 year headwind with everything I made outside the US that got translated into my home currency. It went up. I kind of think of it, I fly a lot, right? Seattle based. So think of it in headwinds and tailwinds you're on the plane, right? I fly somewhere. I fly 1,000 miles, right? Well, if I fly there, it's 1,000 miles. And if I fly back, it's 1,000 miles, right? That doesn't change. That's kind of like my return. So let's just say that's a return of, say, 10% or whatever. Well, when I go there, though, what happens? I get there quicker, which means I get kind of a benefit. That's almost like thinking of the currency benefit. I got the same 1,000 miles, but I got there faster. What happened when I flew home? Got the same 1,000 miles, but I lost an hour or I lost some time, right? That's kind of a negative. So it detracted from kind of my return that I got from my miles. So that might be a easier way to kind of think of how it works. So yes, there's many reasons why you want a strong currency. No politician's ever going to run on weak currency. That doesn't sound very good, does it? But there are some benefits. And if we enter into a period where the dollar at least stays where it's at relative to other currencies or drops a little bit, again, you kind of get that kicker in your non-US holdings. So to put a bow around it all, we're still comfortable with 2/3 of our money here, kind of our market cap, market weight in the world, and 1/3 of our money elsewhere. Again, I like elsewhere. I get different exposures. I get a cheapness of price, and I get a little bit of a currency kicker that we've talked about. All right, let's move on to a few other things here. Let's talk a little bit about I love this slide because I think this might be the most relevant slide for anybody who's on the phone here, because this is really about planning assumptions, right? So we're at the turn of the calendar. You're probably meeting with whether it's Sean or Jason or any of the advisors that invited you onto this call, and you're saying, so what can I expect for the year? What's kind of markets have done great. You know, where are we at? So I like this as a simple framework. Now, there's a lot of math behind the framework, and some of that's in the box. If you don't want to look at the math, then just cover the right-hand side up and just kind of look at the grid, right? So let's talk about stocks. We don't put out an annual projection for what the market will do. A lot of strategists do. They all tend to cluster. Most people will kind of be in that 5 to 10% range every year, even though the market has done better for 100 years, because it's a safe number. It kind of makes sense, right? And I think it's a logical starting point, and I think it's a reasonable starting point for this year as well, too. I still think you might do better with the non-US portion of it. But between US and non-US, expecting from a planning assumption to earn 5 to 10%, I think it makes sense. You've already made a couple percent of that already. It's been a nice start to the year. That kind of puts you in that, it's on that top part of it of if I own a 60-40 portfolio, so 60% of that return I'm going to get, I'm kind of in the upper quadrant here of what I think markets might do. Okay. Now, that's the stock side. Well, what about the fixed income side on the left? And this is where the math gets really hard, and there's a lot of calculus involved in fixed income. So if you ever tell your kids when they wonder why they take this in school, tell them they're either going to be a fixed income or a derivatives trader, or they're going to build bridges. You know, there are practical applications to the math, but the math gets hard. So I like this because it simplifies it, right? Interest rates are going to do one of three things, right? They're either not going to do anything, they're going to be no change, they're either going to go up or they're going to go down. I mean, right? So, in the world, to simplify the math, if interest rates drop, the value of your bonds goes up. It's always an opposite relationship. And again, you don't want the presentation that walks you through a lot of that. We've tried to simplify that in the orange box, but that might even be more than you want to see. On the flip side, if interest rates go up, the value of your bonds goes down. Well, I already talked about what do we think the environment's going to be for interest rates this year, at least on the very short maturity. So kind of the cash level to the 2-year maturity. That's kind of what the Fed controls. We think they're either going to stay right around where they're at, or if the labor market continues to weaken, while if inflation stays somewhere between 2.5% to 3% a year, which is where it's at right now, they will have the flexibility to lower rates in later in the year. I think there are less likely scenarios on why they would raise interest rates. So I'm in that no change to fall category. Okay. So if I find the intersection between 5 and 8% on the stock side and no change or fall, you can kind of see what you're talking about for what's a reasonable expectation for a 60-40 portfolio. Now, it's not quite 60-40. We throw in some real assets, which depending on the mix is infrastructure, global real estate, as well as maybe some natural resources, which kind of play like commodities in the tax managed lineup. They tend to return not as well as stocks, but better than bonds. So, but that's kind of the mix. You're into this range where I think you can have a logical conversation or a reasonable conversation about what's a realistic expectation. And most of what we're talking about probably fits right into your planning assumptions. So again, as a kicker to your new year, as you're talking about your own plan, I just like this framework for let's just talk about what might happen this year. Obviously, none of us know. Everybody talks about black swans. What could happen that no one sees coming? I always laugh at that because if we're talking about it, you kind of see it coming, right? So it's usually the thing that you don't see coming, but a reasonable expectation, I think it puts us kind of into this range. So I like this chart. All right, let's move on. I think we're into gold. We rarely put a gold chart in, but when it has this kind of a run, yeah, we put a gold chart in. And one thing I hear all the time is gold's great with inflation. I want to own gold in inflation. It beats stocks with inflation. Well, not so fast. And I've been saying this for a long time. Gold does fine. I mean, sometimes gold wins with inflation. Sometimes it doesn't. Sometimes it wins when there's no inflation, right? And then what you see on here is you see the return on the left and you see the inflation. And as you move to the right-hand side, inflation moves up. In most periods, even with modest levels of inflation, stocks still beat gold. Remember, you don't get any income on gold, right? There's no dividend that comes with that. Now, if you have a period like 1979, yes, and I was 15. I do remember it. I remember sitting in the gas lines. And I lived in LA at the time with my dad. I remember the inflation then. Yeah, that's a pretty good environment for gold. But remember, with stocks, companies can pass on things, a little bit of inflation and still do fine with earnings. They can't pass on a lot of inflation, but they can pass on some. So in most inflation environments, stocks, as you see on here, still beat gold. When does gold always do well? It does really well when people are scared. Then it becomes its real defensive qualities. So what are the drivers this year? I do think, as we talked earlier about, ties in with weaker dollar. Some people are pulling some money from maybe the dollar and parking it into other kind of defensive areas, which would be gold. I do think central banks are doing some of that. They're pulling some of their reserves. Now, 80% of world trade is still done in the dollar, and I don't think the dollar has any danger of losing its reserve status. But if you were to pull any money from a huge market and put it into a much smaller tradable market, which would be gold or silver, those prices go up pretty quickly. So I think you have some unique things going on in gold markets that have certainly helped you as an investor. And that's happened this year. Ultimately, should you own it or not, really comes, I mean, personal decision, quite frankly, and one that is a great one to have when you're having your planning meetings. And as I've said before, there are some people that you've owned gold your whole life. Your grandparents got you in gold coins. You know that it goes through periods where it just doesn't do anything. And you don't have, you pay, don't, you know, you have to pay for it. You might even have to store it if you actually own real gold. It's not the easiest asset class to own, but then it has its payoffs. Other folks never ask me about it. And quite frankly, it is the one area I will go years without being asked about gold in any sort of a Q&A when it's sitting around 2,000, 2,500. Now it's at 5,000 and it's the number one question coming up, which tells me you're buying it high. You're not a long-term holder. You're not interested in it when it's cheaper, but you're really interested in it when it goes up. That's where you got to just have a conversation with these guys and make sure it makes sense for you. I do like owning a basket if I'm going to, because then I get oil and then I get silver and I get rare minerals and I get all that stuff. And I'm not relying just on one commodity. So very much have a conversation on it. There are right holders of it and not people maybe built to own gold. But because of the run that it's had and the little unique environment and drivers we've had this year, we wanted to put an exhibit in and just show how does it do versus stocks and what periods does it really shine in. All right, just a couple more. This is for the policy wonks out there. If you love to hear everything going on an hourly basis on a variety of policy issues, this one might be for you. So this is how we get to our economic number for the year. So we're somewhere around 2.5% economic growth, which again, for a large, developed, mature, demographically aging economy, that's a pretty good number. And that's what you see on the right-hand side. And all we did was kind of break down as much as we could show in an area that was more visually appealing than all the models that we use that go behind it that, yeah, you don't want to look at. So let's kind of go through it. Number one, most of it is trend. What does that mean? It means, we're a largely consumer-led economy. Americans tend to spend when we have money. We tend to spend when we don't have money. That's also been a trend over my 40-year career. We're kind of a 2% growing economy as a base case. I think that can continue this year. Again, not everybody's participating. It's being driven by wealthier consumers, but because of the factors in play, that's kind of a starting point and actually explains most of our view. And then you got things that detract it a bit and things that add to it. So let's quickly hit on those. Now, these are all in isolation. Well, the world's never in isolation, right? Tariff policy does not happen and the rest of the world stops. Deregulation doesn't happen and the rest of the world stops. So this is our on the edges, or what do we think as its own factor? Is it helping or hurting the economy? Now, just because it's hurting the economy doesn't mean that I think it's bad, and that the fact that it might be helping the economy means I think it's good. There's all sort of societal arguments, short term, long term, you could have about whether or not these things are good or not. I'm just talking about, does it add in the short run to our economic view for the year? And therefore, is it probably going to be additive or subtracting from return standpoint? Not making any sort of judgment view. The ones on the left are the ones that were the most attention in the first year of the administration, tariffs and immigration, right? Now, tariff policy, inflation, it's really hard to figure out how much inflation coming through is from tariffs or not. Again, because you can't just separate it in its own, but it's a tax that somebody is paying, whether the importer is paying it, whether the exporter is reducing the price of the good they're selling because there's a tariff, whether you and I are paying for it at the store, somebody's paying for it. And generally, if it's a tax or acts like a tax, tends to be negative for the economy. Immigration. Immigration is where a majority of our labor supply has come from at least the last 5 to 10 years. That's been the supply of labor. Well, the supply of labor is gone right now, right? Again, I'm not making a judgment on whether it's good or bad. I'm not having that conversation. When you add that into the fact that we are demographically continuing to get older, Dan doesn't, but somehow I hit 61 this year. I don't know how that happened. And AI, particularly for those of you that have college grads, are going, man, it's getting harder to find entry-level jobs. All of those are adding up. The labor supply is lower than it was. All else being equal, labor supply gets contracted, that's fewer people that are spending. It's not as good for the economy. So those factors, and uncertainty is always a slight negative to kind of views about anything. Sometimes it's more heightened than others. Those were kind of the first year drivers, which again makes it remarkable on how well the market did with this. Now, as we get closer to midterm elections, no surprise, the things that tend to be a little bit more of a lift for the economy, politically speaking, happen closer to elections. So financial conditions is simply Fed policy. That's what I talked about. And it's it's pretty accommodating. Again, rates are either going to be where we see them at or probably drift down a little bit. You make interest rates go down, you make that cost go down. That tends to be additive. People spend a little bit more money. Fiscal. Both sides of the aisle spend a lot of money. That doesn't really change. Usually there's some goodies that get thrown in as you get closer to the election. We'll have some, tax returns that'll get spent. It kind of goes into that bucket. So again, does the debt go up if you have more borrowing? Yes. Is that good in the long run? Probably not. But in the short run, wherever the spending comes from, whether it's from profits or from debt, is it additive to the economy for that year? Yeah. So fiscal gets a bump up, and deregulation is an expense. So again, you can argue whether it's a good expense or a bad expense, but if you're a company, it's an expense, and if you have a more deregulatory environment, it's an expense that goes down. Well, the expense goes down, my earnings go up, and that's good for the economy. So when you add in kind of these factors and where we're at in the economic cycle, these are the things that we kind of look at, the things you're hearing every single day on the news. But what I like about this is at least it kind of gives you an idea if something's being talked about, A, what's the likelihood of it really happening? We always have to ask ourselves that. But is this something that on its own probably adds or subtracts? So we think we are not in a recessionary environment this year. We think we're about a 2.5% grower. We're growing a little faster now. I don't know if that's sustainable, but this is how we break it down. And this has either been the worst 10 minutes of your life that you spent hearing me say this, or if you're a policy wonk, maybe this is your favorite slide. All right, let's wrap up with my last one. I kind of alluded to this one earlier, and it kind of rhymes with the opening slide, right? Man, what if I just hit the wrong period? What if I started investing right before the tech bubble in 2000? Well, what about right before the great financial crisis? What about right before COVID? And I remember COVID. The market dropped 35% in March of 2000, which was when the reality of COVID hit our lives. That's when we shut everything down. We stayed in our homes. We spent, well, ultimately got trillions of dollars of spending, which led to some inflation, but we shut our life down and we didn't know when we were coming out of this, right? And we had to figure out how to educate our kids and do our jobs and all of that, right? So in all of these periods, yeah, the market dropped if you had the timing of getting in right before then. But as I talked about earlier, for many of us, longevity is the real enemy that you have to battle here, right? And as you see, time heals all wounds is the saying, right? Well, investing, it's very true. You got it back. I mean, if you got out, again, you would have had to say to yourself, I'll get back in when things are better. And in some of these cases, the bounce off the bottom was very quick and very sharp, and you would have missed it, right? So it all comes back to planning, obviously, but kind of tying in how the market is done over long periods of time, tying in this with, well, what if I actually have the worst timing of it, and some of the ideas and concepts in between. Hopefully, this gives you a pretty good sense of where we've been. Phenomenal year. I'll take 2025 all day long because it didn't matter where you were at, as long as you were in the game, conservative, balanced, aggressive, you did fine. But a little bit of where we've been, a little bit on where we're going. And the good part about this group is I get a chance to keep the conversation going and update the conversation as we go throughout the year. So with that, I'm going to turn it back over to these guys, see if there's any questions or if this is an environment to do that. Otherwise, I hope you guys all enjoyed your lunches while everybody's off camera and got through some emails or had a productive 30 minutes. But back to you guys.
Mark, awesome. Thanks as always for the thoughts and comments. Jason, do we have any questions in the Q&A?
No questions in the Q&A as of right now. So yeah, if anybody has anything that they've been thinking about since Mark started sharing all these wonderful slides with us, yeah, feel free to speak up and throw a question in there.
This deck is available if anybody wants it. And there's 15 more slides that I didn't cover. So be thankful for that. So but just talk to these guys and you can get it.
We did just have a question
Okay.
pop in. Is Trump economics more volatile than other administrations?
Yeah, it's an interesting question. It's certainly more vocal. It's certainly more expressed very often. But, and, you know, and I said this last year, and I'm going to continue to say it. It'll be really interesting when it's all said and done and we look back on what got implemented, right? I mean, tariff policy gets talked about all the time. Now the market doesn't really even move on it because it's just used to it, right? And tariffs get announced and then they just don't happen sometimes, right? Or they get pulled back. So, and quite frankly, we had tariffs under previous administration too, under Biden. Remember, Trump put tariffs on, Biden never took them off, and Trump has them or has added to them. So we've had tariffs kind of around for a while, and yet we feel like it's being talked about every day, and it's always talked about in the negative. Therefore, it must be bad. Fed policy is another very interesting area, right? And Trump has made no secrets that he wants interest rates lower. But remember that the Federal Reserve lowered interest rates 3 times last year. They lowered them, 0.75%. And what happened? The short end that the Fed controls, cash to 2 year, went down, but the long end, the 5 year, the 10 year, the 20 year maturities, quite frankly, which is maybe more important than anything else, because what's your mortgage priced off of? The 10 year area, right? They actually went up because people were worried about inflation. So it's almost one of those, be careful what you wish for. The Fed actually did cut interest rates last year, and yet the end of the yield curve, which is what I think the administration should be the most interested in, actually moved up. So right now, the 10 year is very stable, right around 4.25. So no matter how much is being talked about with Fed policy, it's actually been a very stable environment, and that's what companies like to see. So I think it'll be interesting when it's all said and done to look at what actually got implemented. You could say this about any administration on either side of the aisle. And was it that different? I mean, you can see our economic outlook, the 2% trend of just we're a large consumer-led economy is almost all of what we think is going to drive the economic return for the economy this year. And all these other 6 areas that get talked about, add a little bit, subtract a little bit, because what actually gets implemented or not. So I think you have to separate what's discussed versus what actually gets implemented. And remember, we're at a midterm election period. History tells us that the party in charge, doesn't matter the circumstances, loses seats in the midterm election. Republicans lose a couple seats in the House. It's split party. And I don't know what can get done in the last 2 years, but you can say that about almost every administration, which means all the policy things get pushed through the first 2 years. And that is exactly what we're seeing in this one. So I think the jury is still out, but in my experience, we are a self-contained, less trading, consumer-led economy, and following Fed policy and earnings, they still drive markets, and a lot of other stuff that gets talked about seems to kind of fade over time. So it'll be an interesting case study when it's all said and done. But there's no doubt that and why I think you see consumer sentiment down, it's exhausting, right? I mean, if you like what's going on, it's exhausting. If you don't like what's going on, it's debilitating almost, right? So I do think there's that aspect of it that has made it all feel as if there's a lot of different things going on, but when it's all said and done, we'll see what actually does. And again, I'm only looking at the economic drivers more so than everything else being talked about. So sorry, I just realized that was a really long answer. So yeah, scared off anybody from probably asking one, but yeah.
No, that was
Anyways,
a great response. It's a tricky question.
it's a tricky one here.
Yep.
And the debt just goes up under both sides. That's the one thing that's consistent. No matter what gets talked about, no matter what gets campaigned about, we borrow more money than we bring in. And as I've talked about in previous calls, we just get away with it in the US because of the economic power and engine that we are. So we have a lot of things that we benefit from that would almost be a separate call on why the US gets away from it, gets away with it. Doesn't mean that that's not a problem in the long run, but in the short run, I think it's a longer runway than other countries in the world have, and that kind of status quo exists under both sides of the aisle. Yeah.
Perfect. Mark, there's no other questions, I don't think, in the Q&A at this point, but from a leading economic indicator standpoint, going into 2026, how different do those look than going into 2025? You see a huge difference?
No, I think they're pretty similar. I think the four things that I mentioned that drove last year are probably the drivers for this year. Again, it's the continued AI spend. And then we're talking, I mean, there's been comparisons like all the money that was put into like the reconstruction after World War II. You throw in, you know, the Manhattan Project. You can throw all these numbers in, and it doesn't match what these companies are spending on building out infrastructure in order to fund the new technology that we have here in the energy space, et cetera. So again, so I think that driver continues. The wealthy consumer, it'll be interesting. I mean, at some point, does that group pull back? And what I mean by wealthier consumer, generally it's the top 20% of earners. Again, we're seeing that huge buildup that was in savings accounts. Maybe because the CDs that were 5 and 4% are now 2%. That money's either being spent or maybe being redeployed, which is an interesting thing that we'll have to watch. I don't know if a lot of cash goes into stocks because that's a pretty dramatic risk off, risk on move. But boy, I bet some of that's moving its way into the bond market. I don't want to own the cash, but I'll buy a 2 or 5 year, maturity security. So it'll be interesting to see that. But that group spending still intact. Earnings still look good. Fed policy still accommodating. So I think the drivers heading into, and now it doesn't mean that I think 2026's returns can be what we saw in 2025. That would be a very bullish scenario. But again, I think the drivers for what can make it go up are known. The question is, what's the drivers that could take it down? And again, I could list off 25 things that have happened in the last year that would have been things that you would have thought the market would have taken a pause at, and none of them have done that. So that's what'll be interesting to see what plays out for this year. But the drivers that we can identify, I think, are pretty similar to the drivers we had going into last year. Yeah.
Well, that's great. And your comments about commodities, make sense, and totally how we, treat them as a, smaller percentage allocation, right, to an overall investment. And gold makes sense, really as a kind of that defensive play, as you said. Right. Silver's been super volatile as well, which is really kind of interesting. And I was just curious, is most of the growth in silver related to the same defensive idea with respect to gold, or is some of that growth related to the fact that it's being used for AI data centers and stuff?
Yeah, it's both. I mean, it's always kind of called the poor man's gold, right? Because you can get some of the defensive qualities for a tenth of the price. So I think that's part of it. So yeah, you get a big move in silver. Yeah, percentage wise, it's huge, right? So I do think part of it is that, and part of it is yes, it does actually have commercial aspects to it, where gold is largely, you own gold because of gold. So, and I like how you frame it. Again, I look at it more as a defensive holding, not necessarily an inflation play. Because again, I think you can show sometimes it is, sometimes it isn't. But that defensiveness is probably its best quality. And again, as an investor, what makes it so hard is it's just what we call it is it's just an episodic return pattern, meaning it can just stay dormant for a while. And we get really impatient as investors, and then you tend to sell it at the wrong time. So that's why I think as an asset class, it's crucial that you guys are involved in that conversation to explain that for the individual and if it makes sense or not. And to know what is the reason that you're holding it for, rather than just make a blanket statement that everybody should own it or nobody should own it. And I don't think that's really ever the answer to anything. So,
yep. Wonderful. We really appreciate your time, Mark. Jason, do we have any more questions or?
No questions. You must have touched on all the hot burning questions that were out there, Mark.
Well,
great job.
Done this a few times, so I think I might have an idea what's on people's minds. So, and again, the team like Ryan, so instrumental, who you talked to last quarter, who builds this deck. They just do a great job, I think, on hitting on the themes. So, we can spend 16 minutes talking about the Seahawks game, or something like that. But I guess I should have warned something. But anyways, pretty exciting weekend ahead. So we'll see how it goes.
Absolutely.
I had a good time. I did a bunch of calls for Dan's colleague in the New England area. So we actually did spend a little bit more time than maybe we should have having that conversation. But, understanding the clients that were on the call, I treaded lightly, but I had to say a couple things. So, anyways, it's exciting. So, hope it goes our way. But I guess we'll all find out together. So, thanks as always, guys, for the time and for having me on. And we'll see where this year takes us.
Absolutely. Thanks
Thanks,
again,
Mark.
Mark.
All right.
Everybody on the call, we appreciate you. We'll see you next quarter. Thanks, everyone.
Be well.